Hit it.
It's Friday, June 2nd, 2023, episode 214. I'm Patrick Serezna.
And I'm Kevin Muir. This week, it's a no-guest show, so it's just Patrick and myself shooting the shit about markets and life. Completely understand if you hit stop and tune into the next show. No one will blame you at all. For the rest of you, we have all the regular Market Huddle segments, starting with Patrick's Talking Charts.
And we'll end with the no stupid questions and skin in the game. And folks, stick around. We might even drink some beers along the way. Lena, hop on here. What beer am I drinking this week?
So Patrick is drinking. Oh, you had to pick a Portuguese beer that I can't speak Portuguese, so I'm gonna butcher this pronunciation. Hebendita Milkshake Passion Fruit IPA.
Yes, a milkshake passion fruit IPA.
Sounds very interesting.
Ooh, it's actually not that bad. It's a little sweet though.
That's what he says every day. It's like beer. It's not that bad.
All right,
let me
give
do
us
the
a
side effects. Yeah. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include the placid petroleum disorder, something I suffer from problems, but most guys do. Irritable Vol syndrome and the collapsing copper lungs.
I got hit with the Vol syndrome today. So, all right, let's get to talking charts, bud.
Okay.
So listen, we have to start here. Talk about the top three things we were watching last week, or the last 2 weeks. Obviously, what was going to happen with the big tech, and they just kept ripping. The jobs numbers, which I'll get your opinion on, and the budget deals. So, what's your take on the jobs numbers?
What is this, 14 times in a row that they've come in higher than expected?
Yeah.
It's just, it's shocking how strong the economy is and how it just refuses to roll over.
But the unemployment rate uptick, though, like, how do you square that one?
Well, there's always differences between the different surveys, and you got to be careful about it. And one of the things that I saw was that the Fed whisperer, what's his name, Nick Tismaris from the Wall Street Journal, he said there's something for everyone in here in terms of if you're hawkish and you want an excuse to tighten, there's something there. If you're dovish and you want to pause and at least take a skip, there's something in there for you as well, which is what you're mentioning. So there is a little bit of everything in there, and I don't know. At the end of the day, though, bonds were down. Dollar was up, stock market was strong. I think they're interpreting this as the economy is stronger than expected.
Yeah, back to the big tech number three. Obviously, NVIDIA had that ridiculous rip in the last 2 weeks. But the big tech just kept ripping. But what I want to talk about when we get to the charts in a moment is the fact that they were the ones that participated the least today. They were the laggards. And so we'll pull up the chart on that. But anyway, any comment on the budget deal stuff?
No, the budget deal was always difficult because, as I mentioned, let's imagine that you thought that there was a 20% chance that it wasn't going to go through, which would have been significantly higher than the 5% or 4% that the street had been pricing in terms of the U.S. Credit default swaps. And even if you thought that chance was much higher, you still think that 4 out of 5 times that it's going to go through, which is exactly what happened. So I'm actually kind of pleased at how little drama there was. And I think the surprise was how little the Republicans got in terms of cutting back spending. And this, if I was to say one thing, I would kind of echo what we've heard Marko Papic from Clock Tower Research talk about numerous times. He says that the median voter has shifted towards willing to spend more. And I think that the kind of this deal reflects that reality.
Right. Okay, so let's talk about the top 3 things to watch in the next 2 weeks. So number 3, I wanted to just highlight market breadth. And particularly the shift that happened today, right? And one of the things that we kept talking about over and over again was the fact that there was just no broad participation. The market was incredibly narrow. I am based on the metric here. I'll just quickly pull up the chart on this, but based on just simply using a 50-day moving average, the number of stocks in the New York Stock Exchange trending higher or lower, we were down at 38%. 8% yesterday. But the crazy part was that just how the market breadth came back with a vengeance today on that jobs number. Like we went from 38 to 58%, and just so many stocks rallying. We'll go through a lot of them, but like financials ripped, a lot of the consumer discretionary names, all sorts of different names just that were dead before suddenly all came to life here.
Well, and one of the things that I think is interesting, Patrick, is that on the first day of the month, we saw, or sorry, let's just back up. On the last day of the month, you'd expect AI to rally because we were in a situation where folks were underweight this brand new tech. They had to put it on their sheets and show it. The first day of the month, I think it also rallied because we had, let's just say, new exposure that people were overweighting on that AI kind of theme getting into the market as well. The real question now is, are we seeing folks that are tactically deciding, look, this AI has ripped, and if you look at things like QQQs versus IWM or S&P 500 market cap versus equal weight, many of these indices that are kind of style or size or concentration constrained or differentiated have hit extremes that we haven't seen in a long time. So for the first time, I think we're starting to see some folks say, hey, I'm willing to take a punt on buying some S&P regular mid or equal weight instead of buying S&P 500 market cap weight, because let's face it, I'm really, if I'm buying the market cap, I'm getting market cap weight. I'm getting what, 7 stocks that are worth 29% or something.
Yeah.
It's large. And 1 second, just back up, Patrick. One of the things that we talked about is that I really think that the economy showing that it's resilient, it didn't make sense before when we were getting strong economy that they were buying and concentrating on those tech names. Because traditionally, the experience that we saw was when rates rose, that the long duration assets like tech, like big cap tech, sold off, and people went into the more kind of value industrials and things like that. And so I wonder if today is a sign that traditional relationship has at very least reasserted itself.
Well, one day doesn't make a new trend, but one thing that I've been telling my members for weeks is that we're not going to 43 to 4,400 on the S&P based on the back of the tech names. The breadth would have had to return, and so now it's interesting that literally the day the breadth returns is the day we punch to that 4,300, and if we are going to see more of this pain trade, right? The pain trade is everyone is underweight the equities, concerned of the impending recession, and the pain trade is to them being forced to allocate and chase this market because they're suffering FOMO. And the question is that how much gas is in the tank for them to squeeze it, and how high can it go in this sequence? I mean, I still am generally bearishly inclined, but
that's a shock.
Yeah,
I'm
shock.
actually shocked. I'm really shocked.
But
very unusual for you.
Very unusual, but the thing is that do we first have a trip to like 4,400 here? Like, this is really interesting that we're seeing it this way. Anyway, so let's move on.
Before you move on, just in terms of that market breadth, I think that everyone was highlighting it. You turn on CNBC or Bloomberg, that's all they're talking about is market breadth and how it's so dangerous because all these, the 7 stocks are the only things holding it up. And it just seemed to be that everyone was convinced that once those 7 stocks rolled over, that was when the real selling was going to occur. And I've been pushing back a little bit about that and saying, no, what if everything else catches up as opposed to, the big 7 fall back down? I'm not as convinced
but that is the only circumstance that I see a room for a bull move to happen. That's why I think watching what happened here on Friday is so important. The one day doesn't make a new trend. It's got to be what happens next week, whether they follow through on it or if it's faded. Obviously, the TGA account and other things like that may play a role. We'll talk a little bit more about that in a moment. But anyway, number 2. I wanted to highlight that over the weekend we are going to hear from OPEC, and obviously this is oil's been incredibly weak, and obviously breaking down. The question is, are we going to see something, some further production cuts from OPEC to kind of shore up prices? Are we and maybe help establish a short-term low on oil? What are you thinking?
I don't know. When you have to guess about like a bunch of countries getting together and coming up with something, I'm reminded of that video of Paul Tudor Jones I think it's called The Trader. And in The Trader, he's sitting there and he's shorting crude oil because he says that whenever, 7 people or, whatever it is, 12 people, 12 countries get together to agree on anything, I'm betting that they don't agree. And if you're buying oil solely because you think that these countries, this oligopoly or whatever you want to call this cartel is going to raise prices, then I think that that's the wrong play. I think you should be playing it because you think that the supply and demand. And if I was to argue about the bull case on oil, I would say it has more to do with the fact that most folks think there's a recession coming, and that all the speculative length has been sold out. And I would even contend that there's a lot of shorts out there in terms of folks that are betting on a recession, and that's tradition. Listen, if a recession comes, it is the right play. That is traditionally what has occurred in terms of oil has collapsed or gone down during a recession. So if you think a recession is coming this summer, then you should be staying short oil.
Yeah, but you know what? I've been kind of the mind frame that it's one of those scenarios that the moment a recession is confirmed, that it will actually mark the bottom and it will just rally all the way through the recession. It's one of those,
it could be, but the reason that would occur, Patrick, is because everyone is shorting now on the anticipation of a recession.
Exactly. It's always the trend move is in the betting on the anticipation and then covering on the news. The interesting part. Okay, so here's the crude oil, and the one thing this is the WTI July contract, and one of the things that I continue to watch in general is that huge trade range that's been established from, let's say, September of last year all the way through March, arguably even through April, other than that one little drop down. And this was a very high volume traded zone. And to me, in order for the bulls to just neutralize the downtrend, they need to punch oil back into this trade range. And so, it's nice to see that there's a bit of a bounce. But if we, on Monday after hearing from OPEC, fade back down below $70, then there's nothing to get excited about. I think that the bulls really need to show that they got something going here.
Couldn't you also argue, even from a technical perspective, if let's just say they do a lukewarm sort of announcement, it's some cuts, but it's not enough. Can you put your little squiggly squares up again?
Yeah.
Let's just see what you got there, and you put your squiggly squares, and you draw this range.
Let's say 75 to 80. Let's say,
right, but let's just imagine that we're 73.5 right now. Where are we? 72. So 72. So even let's just say we got a kind of a lukewarm rally up to 74, and then it just kind of. If you look at that, the previous bottom of the range, which was support, is that not going to become resistance on the way back up?
That's what it is, right? Like the point is that in so long as we're failing below $75 on each push higher, then there's no evidence that the trend has changed.
Right, and so stay short as long as it's below that.
Well, I don't know about staying short, but basically, I wouldn't be too ambitious about being long. Yeah. You don't want to be all in until the trend is your friend. But the one thing I wanted to highlight was just having a peek at the Brent oil futures, right? And what's interesting here is that they did a very clear double bottom. What's interesting is that sell-off that happened in May that hammered the WTI contract to its previous lows, Brent didn't do it. But here we had a perfect test of Brent back down to those $72 lows. And the key is in the last 3 days, has wiped out almost all the last selling. It'll be interesting to see whether Brent can recover north of $80 at the same time. It certainly OPEC becomes a catalyst for us on the short term.
But before you go off of oil, I just wanted to say one thing. Did you notice that Pierre Andouran, which listen is one of the greatest oil traders that's ever lived, and if he ever wants to come on a show, he is more than welcome, because this guy swings his bat. He is always going for the bleachers, man. This guy just never goes for singles. Do you know what he was down in the I guess this would be.
Oh, it was more. It wasn't it like more than 30%. It was
okay. No, but he's down 46%. But the point is, he was down another 9.5% in terms of for the month. So like, but oil's not down that much. So the reality is, if he's down 9.5% for a month, he's using a lot of leverage. I like this guy's style. I think he's going to be right. As long as you can hold on, and it's scary AF, but it's kind of awesome because he's old school. I love him. I love him. Yeah. I love anyone that's just kind of willing to go for the stuff like that.
Yeah, and so number one thing to watch over the next couple of weeks is the FOMC meeting that's coming up on June 14th, I think it is. And obviously, the question is, will we see another rate hike still, or are they done? And the interesting part, I just want to put up here, this is the CME probability target for June 14th. And right now it's being priced at a 70% that they stay at the same rate, and a 29% chance that they're going to hike. And so the question is you think they're going to stall here?
So, first of all, you should always just go with the market. If the market says that it's like 70% chance they're going to pause, they're probably going to pause. Yeah. The people that are betting with that are well informed. They understand the game, and if that's where it is, that's the most likely scenario. The one thing I will say, and I'm going to quote Jim Bianco, and you know, some people give Jim a hard time. I actually really like the guy. I don't agree with his market calls all the time, or his analysis, but not his analysis, but that's what makes a market, and I enjoy hearing him. And by the way, he's got the best looking charts, hands down. That's like, he's just, when you look at charts, I'm like, I think every single sell side research should go and look at Jim Bianco's charts and take some lessons from him, because this guy knows how to make a chart. Anyways, he wrote this, and I think that this represents the kind of hawk's view. And I'm just going to read it. He tweeted it out. He said, when the Fed lifted rates off of 0% in March of 2022, Powell warned over and over that there would be pain in financial markets as it was necessary to slay inflation. This pain has almost completely gone. Animal spirits are returning, and the Fed is poised to stop hiking. Does this make sense? And I think what their argument is that somehow they're kind of almost confusing what the goal is of the Federal Reserve. The Federal Reserve's goal is not to get the stock market down. The Federal Reserve's goal is to keep inflation down and maximize economic growth or employment. And you could argue that the stock market reflects maybe too much growth, and therefore they use it as a tool. But just because we're rallying in the last month, we've rallied 5 or 10% in terms of what are we up 10% for the S&P? It's not like we're screaming to new highs. It's not like we have some really shitty stocks going up. These are big, large cap stocks. It's like 2022 was way worse in terms of what was going on. And let's just rewind to 2022. When 2022 happened, we had a situation where interest rates were zero, and they hadn't raised rates yet. They were behind, and inflation was taking off. Now we have a situation where if you look at the 1-year inflation swaps, they're 3% or something. Let me just pull this up. USWIT. I'll just tell you. So let's look at this. 1-year inflation swaps are 237. So the market is saying that inflation over the next year is going to be 2.37. Okay. Now, and then let's look at what the Fed funds are. The Fed funds are, what do we see? Midpoint. Midpoint is 5 1/8. So we're almost 300 basis points of real interest rates. And that situation was completely reversed a year ago when the Fed started raising rates. We had inflation taking off and we had interest rates way below it. So I just think that this idea that because they remember how aggressive the Federal Reserve was, let's just say after they had kind of acknowledged their error and they were super aggressive getting hawkish, they assume they're going to be hawkish. And I think that that's a mistake. I think that the Fed is going to surprise folks and not be as aggressive raising rates as many of these folks, these kind of hawks believe. Anyways, that's just kind of my feeling.
I want to just highlight one thing that's important to note, right? Which is something that we've talked about on the show before, and you leaned into it before. I mean, after Alan Greenspan and Bernanke did their rate hike cycle from 2004 to 2006, the stock market still managed through the early part of 2007 to rip higher. Maybe it's not going to be the same, but the point is that the lag time for the impact of higher interest rates to kick in could be exactly that. It could be a big lag. Maybe the real kind of risks of the market are next year, not this year.
Yeah. Patrick, on that vein, like I did a study where I kind of looked at after the Fed does their last pause, what happens to stock market? Stock market on the whole still goes up. And Paul Tudor Jones was on CNBC and said basically the same thing. He says, I'm bullish. The reason I'm bullish is if you look at the playbook, when the Fed stops hiking, we continue to rise in the S&P for another 6 to 9 months. And you might say, listen, that 6 to 9 months is really sketchy. And then eventually we're going to have a big accident. So I'm not going to play. And that's completely fine. And I understand that argument. But that's a lot different argument than, doom at 11, we're about to collapse tomorrow.
Yeah. I mean, and the thing is that the stereotypical, even when I look at where I'm positioned on my hedges on the downside of the market, I mean, all of them are positioned betting that the market is, or at least, the expiries on the existing cycle of the puts that I have are all positioning in the summer. And so like if you think about the pain trade is that the market first kind of disappoints everybody, and the bulls aren't bullish enough and the bears are too early, and the market just has to reach that point where the time to short the market will be when nobody will want to.
Right. We had a session, just you and I, the other day for some of your members, and you said something about the fact that if you're going to be long, you want the asset to be above the 50-day average, and if you're going to be short, you're going to want to be below the 50-day. And I think specifically you were giving me a hard time about NVIDIA and the fact that I was kind of fading it and fading the hysteria, and you're saying like, no, wait for it to turn and tell you. And I went home and I thought about that, and I thought, you know what, Patrick's right. And that's a variation of Paul Tudor Jones' theory that he says that I only go long stuff that's above the 200-day and I only go short stuff that's below the 200-day. And yeah, he misses some trades, but he also misses making a mess of stuff. And you don't need to be bullish on the stock market. You could say, listen, it's overpriced. And so there's only 7 names that are rallying. It's scary. And that's one thing. But until it rolls over, you kind of have to respect it and be careful shorting it. And if I just showed you this chart, I was looking at it, like zoom out a little bit, Patrick, and like look at this thing. Every low has been like since November, every low has been higher.
Yep.
Like I'm not a technician. You know me. I barely know this stuff. But to me, like if you didn't know what this was, and you were just looking at the S&P 500, you'd be like, you should buy that.
Okay, so let's do a simple checklist, right? Like now, and all listeners know, I tend to be bearishly inclined, so I'm always looking for when there is a short opportunity on the downside. But like, are we above both the 50 and 200-day moving averages on the S&P? Yes, right?
Yes.
Are we using a nice thick crayon? Are we more or less above almost every single trend line you could possibly draw on the upside? Yes, right? Are you above every Fibonacci retrace where every single dip gets bought before it gets down to a 50 or 61% retracement? Yes, like ultimately there is nothing about the price action on the S&P that is bearish,
Yeah. And listen,
right?
I hate it because I don't like those 7 stocks. So it's not like I made it sound like I was more bullish. It's really that it's a lack of bearishness that I really is what I feel, because I have wrongly been bearish on those 7 names. And I'm just like, you know what? They're just ripping in my face. I don't need to fight them. I don't
Yeah.
need to like be short them, and I don't need to fight these things, because if you step back and you think about the kind of Patrick Ceresna 50-day moving average rule, or the Paul Tudor Jones 200-day moving average rule, which you should probably listen to Paul a little more than you listen to Patrick, but you never know.
Well, I'll accept that. That's a fair one.
But it just think hard about being too bearish. And the thing is, if you end up being right, so you end up nailing it in terms of, or you end up nailing the call in that the economy collapses and we roll over, then it's not going to matter if you sell 4,300 on the S&P or if you sell 4,000. Right? Like let it turn around. Like there's lots of chance on the way down to sell
Or
it.
no, at least allow the price action to actually do something bearish. We haven't seen a. Only thing that we've seen was the divergence between that caused by the breadth, right? But look at the way that today the equal weight gap tire.
Yeah.
Then look at the way even the Russell turned up. Isn't that insane?
Oh, I didn't actually realize that candle was such a big long green candle.
Yeah, like it literally in one day is attempting to rip through a 3-month trade range on the upside, right? This is what I mean. Like this jobs number has caused one of these huge squeezes, and it's trickled right across the entire global spectrum, right? Another big up day on the Nikkei, pushing it back to next the Euro stock. The Euro stock, not near its highs yet, but it's had a big turn. But the one that I wanted to highlight is look what emerging markets did with this gap. The emerging EM, or the EMXC, which is the ex-China one, like you're literally seeing the emerging markets having had a huge positive reaction, and I don't know how to square that one in terms of U.S. jobs numbers spurring that, but I think it's just the pain trade. I think all of these suddenly are ripping higher, and everyone now feels like the bus has left the station.
I think it actually has more to do with the time of the month in terms of the trade. No one wanted to buy those before the month was over.
Yeah, maybe it is actually.
No, I really think that's the case. Like, there's a lot of nobody.
But why wouldn't it be? I would see that being a much more relevant thing on June 30th, right? Isn't it more the 1 year or the half a year mark?
I think there is an element of that, and the quarters mean more than the months, and there is definitely a you're correct in that those end up being more important than just May month end. But I think that month ends, a lot of folks just don't want to trade. Like I remember talking to one of my buddies, and he wasn't allowed to trade a month end. Like he literally was not allowed. Like he was just like, I'm not allowed to trade a month end. So he had to mark everything up 2 days before. Okay, what else we got?
We have to talk about the collapse in volatility, though. Did you see the VIX?
Yeah. I don't know why you guys think this is such a big deal.
No, but you know what? what it to me, it's to say a big deal. We haven't seen the VIX trade under 15 for like 2-3 years.
I know, but
Like
this has been a crazy 2 or 3 years,
okay,
and I think we're going back to more normal.
Okay, this is the 3-month vol index, also a multi-year lows. The 6-month vol index, multi-year lows. Like this is the complete and total break of all the.
What's the symbol for the 6-month vol index?
On the trading view, it's VIX 6M.
Oh, okay.
But the point here is that volatility is not, it's not even just 30-day vol. You're basically seeing the entire vol complex completely collapse today, and it actually started yesterday, to be honest. But
I don't think it's that big a deal. It was too high. Let's zoom out. Let's zoom out. Let's do pre-2020.
Yeah. Okay. So, but the point is that we are basically returning back to the pre-COVID levels.
Yes, completely agree. Would you not admit, or would you not say that our society is moving back to the kind of getting back to normal?
Okay, but at the same time, we have, one of the steepest rate hike cycles that is potentially going to inevitably break something and cause something. Like you would think that volatility premium would at least, like they're literally now giving volatility premium away.
They're not, though.
For hedging purposes.
They're not. It's still carrying bad. Like it's not like
it's carries bad. Of course,
like you need your end of the world to happen. Otherwise, that's not kind of coming up. By the way, you're talking about collapse. I saw Charlie McGilligan highlighted that the VVIX, which is what the volatility on VIX.
Okay,
I think that's what it is, or it's the VVIX had a collapse, the 5-day collapse. No, that's not right. Are you looking at the right thing? Is that the VVIX? Okay,
this is the VIX volatility index. Oh, sorry, let me look at a daily chart here. Sorry.
Maybe I got this wrong because Charlie was highlighting that it was the biggest 5-day decline in the VVIX in like ages. Here, let me just have a look. Here it is. McGilligan notes that the cumulative 5-day collapse in VVIX is the largest since 6/27/22. Oh, it's not that big. Like I thought it was longer than that.
Yeah, but there was this big drop right over here back in March, right?
Yeah, no, it's not that. I thought it was a bigger deal than it is. I'm wrong, but that's what I'd expect. That's going to come in as well. Anyways, listen. I know you love you live and die by vol, and that's important. But first of all, you should be happy because the last thing you need is for it to stay rich versus realized.
I love selling income too, though, right? So the thing is,
but you're not selling income on individual stocks, though. On indexes.
No, but I mean it's all intercorrelated. I mean, then you getting to dispersion shit, right? Like,
I don't think it's that unexpected.
Anyway, all I'm just saying, it was a big move. We had
I would agree with
you. To me, the fact that we are at 3-year lows on volatility is to me shocking. If you told me that we would be in this state right now, I would never have believed you.
Yeah, I would say I'm shocked that it took us 3 years to get here. Not 3 years, but I'm shocked that it stayed bid for as long as it did.
All right. Well, let's talk the dollar for a moment.
I actually so proud of you. I didn't get involved in the top 3 things this week. Most weeks.
Well, no, because we always put it as number 1 by default, right? So it should be really the top 4 things. Dollar's always number 1. So let's talk about the other 3, right? Yeah. But the dollar was up today, though. Right, and this is a interesting little thing because overall the euro, I think this 107 level continues to be really interesting. If the euro weakens back to 105 or lower on the short term, then that really puts a tailwind on the U.S. dollar. That's going to really shift the trend. The only currency that's been truly holding up better than the rest has been the pound sterling. But you look at the way the U.S. dollar's been behaving against the yen. It's been just so strong. The U.S. dollar against the renminbi, super strong. Against the Aussie and the CAD, it was a bit of a muddle and a bit of a rebound. But the point is that the U.S. dollar has actually been doing well. And the interesting thing there is that when with the dollar up today, gold gets slammed $30 back down. Couldn't get above the 2,000 level, and so certainly while the stock market is liking this jobs number and stuff, but I would have thought that if we were doing a little bit of a risk on, that the dollar wouldn't have behaved this way, and yet it did. Any take?
You think the dollar wouldn't be up in a risk on environment?
Well, I mean, look, it's not always the case, but typically I would have expected that the first reaction should have been some of the dollar giving it back.
Well, so I would say that it's almost the opposite in terms of I'm surprised the stocks did as well as they did, and it was a risk-on move given what bonds and the U.S. dollar did.
Right.
And I would say almost that bonds, U.S. dollar, gold all behaved like you'd expect in a kind of stronger economic environment. The real surprise was that stocks went up, not that the other three did what they did. Would you agree?
Okay. No, I'm not going to disagree. I mean, I think it's a fair assessment.
I think the real question is what happens in the kind of next, is the U.S. dollar, did it roll over? Or are we going to get kind of a return of the U.S. dollar bull market? And can risk stay bid in the wake of a U.S. dollar bull market? Like today it did, but can that occur for a longer period of time?
Well, I don't. It could, but I just think it would damper the momentum of the market. In other words, a market that could have ripped 10% will probably only be up 5-6% in that environment, right?
Yeah,
like I don't think it has to necessarily move contrarian, but it's certainly not going to be a tailwind. Right? Like it's gonna be something that the market would be fighting. Anyway, so I just wanted to observe that on gold. Like, by the way, if the U.S. dollar strength continues here, with the way gold failed to get above 2,000, it might have a short-term high. My view was all along that this was going to be a very volatile year for gold. Like, I remain super bullish longer term, but I wouldn't be shocked if we had some big, sell cycles that kind of wash out the people that are a little too levered up, but then I think that all dips should still be bought. Like, it's just, I think it's going to be
all dips
really
should be bought,
here.
but you're expecting a dip. Or you think the odds
favor?
I
think there's a lot of volatility risk here. I don't think anyone should be thinking that this is just going to hang up here and hold up there, right? You don't want to have your stops too tight here.
I think the gold is remarkably resilient. And I know lots of people are giving me a hard time going, oh, no such thing as a triple top, ha, ha, ha. And yeah, there's one of the things that they need to remember about that. By the way, Dario Perkins was the kindest guy. He's like, I don't know why you're getting tagged on all these things. I hope you're not offended. I said, no, Dario, don't worry about it. Plus, all the people that are joking about it, they're market huddlers. They're just doing it good natured. They know and stuff. And but one of the things about the triple tops is, there's no such thing as a triple top. It's an elusive creature that we've yet to find one that's actually occurred in the wild. But there's lots of them that look like they're going to be triple tops. So it very well could be that we might even go down to 1,900 and then zip back up to 2,100, and then everyone's going to be like.
I think it could even go as deep as 1,800. But I'm a gold bull at heart, so I'm not going to be shorting it. But I would not be shocked if we printed 1,800 before it went up.
Well, I like the fact that we're on the other side because I of the trade, because I continue to be bullish. No such thing as a triple top. when it goes back up, and then
But-
people are going to tell me, oh, now it's a quadruple top. Now it's a quintuple top. One
Okay,
of these days, the
okay.
more often it bounces above here and keeps trying, the more often it is that it's going to,
Look
go
at
through
this weekly chart, okay?
Yeah, listen, it
And
went
you're
down-
telling me no. And look, if it went down to 1800 and then broke to a higher high, what would be wrong with your no such thing as a triple top thesis?
nothing.
The point is that all I'm saying is that the downside volatility is going to probably be deeper than you think.
Okay.
I still will kind of position that gold will ultimately break to a new high. It's just I think it's going to be bumpy. Anyway,
1 second. I just realized I'm a complete knob. I said Dario Perkins. It wasn't Dario. It was actually Brent Donnelly. So Dario's probably been listening to this and he's like, Kev, it's not me. And he's been thinking about this for the last 3 minutes or whatever. It was Brent Donnelly. It wasn't Dario.
Okay. All right. So listen, I wanted to talk about uranium for just a
Okay,
moment.
listen. When
What-
it
am I not
started
supposed to-
behaving well. The folks on my chat, at the Vancouver Tours, they started saying, please, God, please, whatever you do not gooch your uranium by talking about it. So I don't know what to do. I will do this. I'm going to let you go alone. I will either deny or confirm that I am bullish, and I will let you talk about it.
Yeah, so don't say anything. Okay, so I agree with this statement you're making. So I wanted to just highlight here by putting up just the U308 contract. Uranium has just been in a straight line bull. It's one of the few commodities that has actually been working very well. And the one thing that we've talked about in numerous times in the past was that the trust unit, whether you're talking the Sprott Physical or whether you were even talking about the Yellow Cake trading on London, they were trading at a discount to their net asset value. And this is the chart that we often share about this from Numerico. But we finally seen that gap closing. And so there was that huge rip, whether a Yellow Cake or U.UN. But now that gap is closed, it'll be interesting to see whether or not it starts bumping its head along its previous highs. I'm bullish uranium, but I know you're not, right? So
Well, I'm not going to comment.
There you
There's
go.
no
Okay, so let's
comment.
move on. We're gonna move on. Okay, so let's quickly touch just on how brutal the grain markets have been. Like
They're
wheat,
pretty bad.
like look at these lower highs, lower lows in a huge downwards channel. Corn had a little bit of a reaction, but that was nothing to really get excited about in terms of a new uptrend or something, as well as a little bit of a short-term bottom in soybean. But overall, the grains have been getting killed, but it's those ag stocks that have just been brutal. Like look at the way like Nutrien has broken down, or Mosaic. Like these stocks have lost, just like let's say Mosaic, from its February high is down 45% in 3 months.
It's so bad, it's good.
Why? Anyway, but it's just insane how the ags have gotten murdered. I actually think that there's going to be a trade here at some point, but this is such an ugly chart that you got to leave it alone for now. You have to wait for these things to establish some sort of basing formation. At some point, you got to think that this is going to be a great rip on the upside the other way, but maybe it's not going to be until like going into the fourth quarter where they really have a bigger upside window.
Patrick, you try to teach me. You make me better, and you try to tell me how I shouldn't buy stuff below the 50-day, and how
much of this shit do you own?
No, I'm just kidding. But then you start posting all these great looking things. I'm like, oh God, that looks like something we should buy. That looks really down and out.
Put it on your watch list.
I know.
And you know what?
for it
Even
to
put a
come-
placeholder. Put in 10-20% of the position
it's
that you
just
want.
not the same buying it early and then suffering through, like 3 months of agony while you wonder if you're
That's
wrong.
why I put a placeholder. Just a little one,
But then
so that you.
It's just not the same. It's just not the
All
same.
right.
Unless you have the pain, is it really a win?
You're being sadistic today. Anyway, the Bloomberg Commodity Index, that just tells the story, right? Like, just commodities have been killed all year. Like, it's going 12 months now since its peak. It's been a tough go there. Right? It's Anyway, the one last thing I want to touch on, just bonds. The high yield bonds also, with the whole market kind of upticked. The junk bonds have been so weak, and that was where I was looking to see whether we'd see some sort of credit spread widening and stuff like this. And nope, these things are just. They uptick today anyway. We'll see whether or not they can follow through here. Anything other last charts we want to look at, bud?
No, but I will say on credit spreads, and this kind of is a similar argument to your idea about waiting for markets to tell you, like price action to tell you that to confirm your bias. I actually think that credit will show it ahead of the stocks. And
yeah, I think so. And that's the canary in the coal mine in my mind too.
And while credit is so well behaved, I think it's tough to be too negative on stocks. And listen, and one of the things that we need to be really kind of clear about is that you need to differentiate the different stock indexes now more than ever, because of the fact that S&P 500 or even the NASDAQ is so heavy on those kind of 7 names. So we could have a situation like, what happens here if we have a situation where those things go down, a third, or let's say a quarter, all summer long, and yet everything else goes bid, and a month from now, 3 months from now, stock market's unched, and bears will think they were right, bulls will think they were right, but yet we won't have gone anywhere because the bears will be looking at it and going, look, those 7 went down, and then the bulls will be like, yeah, but everything else went up. So never before have we had the ability to kind of make money in different parts of the market. And that is one of the things that I would suggest to everyone, is that you should be going and trading different ETFs, even more likely individual stocks, and trying to figure things out, because in the old days of just buying the whole market with this huge kind of tilt that we have in it now is not as good. There's a lot of different shifts in there that'll make it more difficult than ever to kind of decide direction.
There you go. Just to wrap up the talking charts, just to remind, it's like, I honestly think the thing to watch next week out of the 2 weeks is simply whether or not that little surge in the breadth that we saw happen today on Friday, whether that trend continues, because I think that will completely change the environment we've been in for over a month. And I think that's definitely one of the key things to just watch early on in the week. All right.
Okay, but wait, before you end here, you didn't talk bonds. Is that because we're going to save it for the bet section?
I was thinking about that. Yeah.
Okay, let's do it. So we're going to the bet section?
Yeah.
Skin in the game. Okay. So last week, or 2 weeks ago, we bet
you got me.
The U.S. 10-year yield would close over or under 3.678 on Friday, June 2nd. Now, going into today, it was not looking good. And I did the old telling you that you were going to win to make sure I did not.
I didn't take the bait.
You didn't. So they, like market gods, they were correct. Like you weren't cocky at all. You kept saying, no, I could lose.
But but it didn't work out for me.
I know. That's sometimes there's more going on than just whether you goocher it by talking to the market gods. So we have a situation where it did with today's unemployment. It ended up, the yield went up and I ended up winning. But having said that, listen, if you had to add the number of days over the last 2 weeks that I was on side versus you, I deserved the win.
Yeah.
Right?
Yeah. No, for sure. Because like overall, it only got under there for 1 day. It was like overall the trend was it was following higher and stayed above for most of it. So yeah, I'll give it to you.
Yeah,
but I was very close.
You were close. And you said, listen,
I was one jobs number.
That's right. And you said, you sent me a note and you said, we won't know who won the bet until 4 p.m. that at the close, and then he says, and then one later you said, I can't believe you're going to win the bet, and then horseshoe up your ass, you said, and then at which I responded, bonds suck, and that's why I won. Okay.
It's truth.
The bonds.
The
Actually, can I talk about one thing that I think is interesting?
Yes.
I was looking at a stat the other day, and I think that actually, it was my buddy Lutz from Jones Trading. He put it out there, and he talked about the fact that I'm just going to pull it up here. SPX. I'm going to pull up the total return, and if I said to you, Patrick, that Powell is going to hike rates at the most aggressive rate that we've seen in how many years? 40 years? Or something like that.
Yeah.
What would the return over the next year on the stock market be? What would you say?
I mean, I don't think that's different than what we talked about earlier.
It's not different. And it's funny because I think today was the anniversary or the point of the first cut, like the anniversary of the first cut or something like that. And we're basically unchanged, or no, maybe it's that we're unchanged for the first time. So the S&P has gone sideways, in this, it's ever since Powell started raising rates. And meanwhile, you've gotten just destroyed on your bonds.
Yeah. But you know what, overall, the bond market is far more trade range bound here. I don't know.
No, I know. I'm just talking about. Let's just get the actual dates because I'm curious here. Let's just pull it up here. What was the date of the first hike? I'm just going to pull it up. So the first hike was March 16th, 2022. Okay, so March 16th, 2022 to today. SPX, I'm showing down 1. Maybe I got the date wrong, but it doesn't matter. But let's now put up.
Oh, you're looking at S&P?
Yeah, you got to do the total return. Okay, so now let's just do the Bloomberg Ag. Where are we here? Ag total. So you're unched on your stocks,
right?
And you're down, 4.5% on your bonds, which your bonds were supposed to save you. And that's on the ag.
Not during a rate hike cycle.
No, but when stocks went down, which is what it did. Anyways, I just think that it's interesting. Let me just do the Bloomberg. I'm sure I'm going to piss off every single bond bull in the world here. Let's just do the Treasury Index. I'm curious about what the Treasury Index was.
Look, I don't think while the stock market was down, 20+% during 2022, I still think it wasn't a stock market bear market. It was a bond bear market, and stocks simply had to reprice based on higher interest rates.
So I agree with you there. And actually, I think it's going to be difficult for stocks to continue to outperform bonds because just bonds now have that inherent current real yield that are going to make it tough. It's going to be tough. Like now, bonds when they're when everything was 1% or 50 beeps or whatever, it was a much easier short. Now all of a sudden, a whole bunch of bonds have monster current yields. So you need to be really bearish bonds. You need to not only do you need rates to go up, and then not only that, you need them to go up enough to actually combat the positive carry they have, and that's a real problem. Okay, anyways, enough. I've probably pissed off enough bond bulls. We got to do a bet.
Yeah.
And
first of all, you won.
Oh, tell people about
the
their
score.
game.
No, but yeah, the score is now 39-34. I caught right up to you, and then I just gave you 4 points here.
Yeah, you were pretty keen about that one. Skin in the Game is our weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and we're playing to 50 points, and at which point someone will take out 3 market huddlers. Okay.
Let's do it.
Let's think about this. I'm going to do the dollar.
Okay.
Okay. Can you pull up the dollar?
It's a trap.
What's the name of that alien that's on Star Wars that he's like, that's a trap? It's a trap.
Yeah, this is exactly what I'm thinking.
General Akbar, I think is his name. Okay, the U.S. dollar. Can you also do me a favor? Can I see the Japanese yen? Because I'm trying to decide if I want to do dollar or yen. So the yen, okay, I'll rather do the yen.
Let's do it.
I'm just gonna do straight up or down. So on the yen. So do you want to do it like the real way or your way?
No, I'm gonna take it up.
Oh, come on. Oh no, that's right. I'm having trouble. I give you a hard time about not knowing how the currency markets work, and then I fuck it up. I'm such a knob. Okay, yeah, you are going to take it up. That's good. Okay, what do you want to do in terms of points?
You know what, that trend's been. No, I'm just going to do 2 points.
Okay, I would go more. I'm not,
I know, but I'm not going to let you go and run away with it.
Okay.
Like I need to chip I need a couple base hits so I can come closer.
Okay, so we're gonna do the yen. I'm taking down. You're doing up in terms of the USD JPY rate, which
and it's
is
it's at 139.91.
Okay, so for folks that aren't trading currencies all day, I'm betting yen goes up. Patrick's betting yen goes down, and
I'm betting the U.S. dollars going up,
yes,
not the yen down.
right. Okay, well, we're done.
All right. Now, no stupid questions. All right, Lena, hop on here and save us.
I don't know how much saving I can do here. So first question, it's a little bit of a long one. Dear Kevin, Patrick, and Lena, you guys often talk with great traders, portfolio managers, strategists, and other professional market participants in the investment management side of the finance industry. I rarely hear you discuss the divide between investment management and financial advising, and if this divide needs to exist. I am curious as to your thoughts from a career perspective on the financial advisor role. Living in the upper Midwest, there are not as many options for positions in hedge funds, family offices, investment banks, and etc. But there is plenty of opportunity if you go the retail advising route. Do you guys think it makes sense to build a book of retail advising business and manage the portfolios myself? I hear from others that managing the investments and the relationships myself would be way too much work with little upside, can't get performance fees from retail relationships. I am 25, love the markets, especially macro, and I'm looking to build a career in trading and investments. Cheers from, oh shoot, I don't know how to say this part. Sheboygan? Is that how you say it? Wisconsin, freshwater surfing capital of the world.
That's cool, man. I didn't know that's the freshwater surfing capital of the world.
It's Dairyland though, Wisconsin.
Cheeseheads.
The cheeseheads.
Yeah.
Exactly.
This is a great question, though. Good picking. Do you want to do it?
I you know what? I want to just start, and I think that you're going to have lots to add to this. So all I want to say is that as a 25-year-old, you have to just decide a simple thing that you love the markets and you want to be involved with it. Like at 25 years old, it's you have to still cut your teeth in terms of the experience needed, and there's going to be so many opportunities that will arise for this listener when they're 30, 35, 40. Right off the bat, they just need I think to get somewhere where they can get exposure to the markets. You know, if you're helping retail investors through being a retail advisor, I mean, it's not where you're going to make your big money as a 25-year-old, but at least it has you not working at McDonald's and not watching the markets. And so I just think that at that age, just getting in and getting some experience in the area where you want to be, I don't see that being a horrible thing at that age.
So I would agree, and I also would kind of echo Patrick's point in that if you're going to be in Wisconsin, then you're right. You're not going to get in. There's going to be no hedge funds or very few of them. I think there was one famous hedge fund that was based there, but I don't know how much there is, how much if they're still there, and if they how much they're hiring. But it's very limited, and I would just kind of echo Patrick's points about just get in somewhere and just start doing something you like and keep trying. And And if that ends up being you try it and you don't like it, then go find something else and keep moving. In terms of, I'll just talk briefly about and I think in the States, what are they called? Registered investment advisors. We just call them investment advisors. Like the traditional broker. More and more, the trend is for them to not do any portfolio management, and for them to just put the client, say the client's 42 years old, has a risk tolerance of, grade C or whatever. Therefore, the mix of it is XYZ. And it really ends up being a game of sales more than it ends up being, and collecting assets more than it ends up being something where you truly love the markets. And if you really love the markets and you want to, eventually be a portfolio manager or be picking stocks, then what I would suggest is that you just, do whatever it takes to get to where you want to go. And along the way, you're going to have to do things that, aren't going to get you there immediately, but that will help and kind of get you a step closer. Like, I think, let's just take that fellow that's on TV all the time, which is Josh Brown. I think it's Josh Brown is his name. Yeah. He started out, he just loved the markets. He wanted to do it. I think he's, in essence, almost worked at the equivalent of like Wolf of Wall Street, like Smile and Dial kind of bucket shop to start. And I'm not exactly sure, but I think he's told the story numerous times. It's not like he started at some, white shoe kind of Morgan Stanley place as a great as a new analyst or anything. He started, where he could get an opportunity. And he just kept plugging away and doing different things. So one of the things I would suggest is, if you end up going the route, you say, okay, I got to do this to pay the bills. I'm going to do this, and I can't really pick stocks. Keep doing it on the side. Make yourself portfolios, even if they're not real, that you're doing and writing things. Like, put your writing up there. Get a Substack. Go on to Seeking Alpha. Just keep showing people and keep learning and showing people that you're interested in. And hopefully you'll eventually, end up where you want to go.
There you go. So let's move on. Next one, Lena.
Second one here. Hi, longtime listener. As the debt default issues goes into the rearview mirror, can you explain the mechanism for how changes in the TGA get translated into equity markets, commodities, and etc.? I vaguely understand how emptying the TGA affected bank reserves through the Fed, but I do not understand how those reserves translated into liquidity for the equity markets and so on. When commentators observe that liquidity has been added to the market over the last 6 months by draining the TGA, who are these marginal buyers of equities that are sensitive to the level of bank reserves? Hasn't the Fed been tight over the last several months? So how do these additional reserves make it into the equity market when the Fed has been restrictive and banks have increased their credit standards? Thank you for the show.
Go for it, Kev.
Okay. So a couple of things here. First of all, there's two parts to that question. There's the TGA, and then there's the idea that the Fed is being tight, and therefore shouldn't that cause risk off and economic weakness? And those are two different kind of mechanisms upon which they are affecting the markets. And let's just start with the Federal Reserve. They raise rates, and when they raise rates, they raise the cost of borrowing. And the idea is, when they raise the cost of borrowing, we see less money being created through private sector credit creation. That private sector credit creation is in the form of, like, when a individual goes and buys a house or takes a car loan out, something where they go to a bank and create credit to buy something. That is that portion of the kind of economy or financial kind of mechanism that the Fed is trying to affect when they raise interest rates. The second part, though, or the first part in terms of the question, which is the TGA, which is the Treasury General Account, is a little more, it's kind of a little more nuanced. And what we're going to do is, to explain it, we're going to step back and we're actually going to go and talk about quantitative easing and quantitative tightening. because in a lot of ways, it's almost the same thing. Okay, so let's just step back and talk about quantitative easing. When a quantitative ease is when a central bank goes out and they buy financial assets of some sort to inject liquidity into the economy. When they first did this, there was lots of people who thought that they would go, and then when the central bank bought these financial assets, what would happen is like JP Morgan would sell them the bonds, and then they'd have all this cash on the balance sheet. And then that cash, they'd run out because they have so much cash, they'd go out and they would lend it again. And with the money multiplier, we would have this, inflation. What happened with the great financial crisis is they lowered rates to zero. They went and they said they can't lower anymore. So they do quantitative easing. Everyone's expecting this huge uptick in inflation, and nothing happens. And in fact, we have one of the worst economic recoveries in the past, 50 years or something like that.
Right.
And the reason that occurred was because we didn't have demand for loans because the economy was so bad. So in essence, you pushed money into the system, and the banks had more to lend. But when you think about the JP Morgan doesn't write loans based upon how much cash they have on their balance sheet. They issue loans based upon the credit worthiness of the buyers and then their own balance sheet, meaning how much equity and other safety items do they have to be able to withstand if those loans don't go bad. So that's kind of the whole theory about endogenous money. And that was to the point where people started to understand, and it took them a while. And if you think back, there was that open letter, the op-ed to the Wall Street Journal, signed by many smart people saying, don't do quantitative easing. It's going to cause, inflation and the dollar to go no bid. And of course, nothing happened. And since then, we've kind of understood that quantitative easing does very little in terms of affecting the actual real economy. But it does affect the financial economy. And ultimately, if you listen to Bernanke speak, he'll talk about that. He talked about the fact that with quantitative easing, he was trying to, in essence, lower rates, cause stocks to be worth more, which would make people feel like they're richer, and then they would spend. And that was kind of, I think it was called they called it the portfolio effect. And that was how they were trying to influence the real economy. Now, some people claim that even that is not true, and that if you think about it, that if the Fed buys and sells bonds, really all they're doing is shifting the composition of their assets, and that it really shouldn't even affect financial economy. I happen to disagree, and I know I've listened very hard to very smart people say, no, it's all a placebo effect. There should be no change based upon the Fed doing quantitative easing, meaning that you shouldn't have stocks going up. It's completely unrelated. I call bullshit. I've just seen it so many times. And the way I even found out about this was I remember sitting around and seeing like the stock market in 2008 or 9 or 10. I can't remember when it was, but at a certain point I was like, all of a sudden I'd be sitting there and the stock market would go offered, Patrick. And I'd be like, oh, it's going to start, really selling off now. And then at 11 o'clock, there'd be this weird bid out of nowhere, and it would just kind of go up all day until I realized that the days that they were doing quantitative easing were the days that was occurring. And one of the things I want to share with you is that I talked about this one time, or wrote about it, I can't remember which way, but this fellow reached out to me and he says, I work for a hedge fund in Japan, and I can tell you that on the days that the Bank of Japan does quantitative easing, we get an order from the Japanese Postal Service. In Japan, the Japanese Postal Service is the largest pension plan. It might actually be the largest pension plan in the world. And the way that the mechanism worked was Japanese Bank of Japan goes out, bids for bonds. Somebody sells them. Inevitably, it's probably the Japanese Postal Service sells at least some of them because they're a big holder of them. They sell them. Now, all of a sudden, they have more cash on their balance sheet, and they invest in more risky assets. And that was how the mechanism worked. And you saw it there in absolute, he said, I knew it. We waited for the orders on the day there was quantitative easing. I don't think it's usually always that direct. And another argument people have said is that at the margin, an investor sells bonds. So the investor that owns the least risky bonds sells his treasuries, and maybe they go out and they buy mortgage backs. And then the person they're buying mortgage backs from goes and says, mortgage backs are slightly more, slightly bid. So I'm going to sell those and I'm going to buy something more risky. I'm going to buy municipals. And then the municipal person sells that and says, I'm going to buy utility stocks. And the utility stock says, and so you get this kind of move along in terms of risk. Another way I like to think about it is just that the amount of investable assets out there shrinks when they do quantitative easing. Now, let's just go back to TGA, because TGA is kind of the same thing as a quantitative easing. And usually when the Federal Reserve, when the Treasury spends money, they issue bonds or T-bills or whatever it is, T-notes, and they issue those and then they spend that money. So they issued, $10 billion and then they go out and they give out social insurance checks. So that is kind of neutral in terms of they borrow. So that's coming out of the system, but then all the spending goes back into the system. Okay.
Yeah.
But when you have a TGA change, it's like a checking account. And if you were to go out and borrow $1 trillion, okay, that would mean that you would have to go out and issue $1 trillion of new T-bills. Okay. And then if you just sat on that, that would be the same as the Federal Reserve doing $1 trillion of quantitative tightening, meaning that they sold $1 trillion of T-bills or whatever securities they were doing.
Yeah.
So,
because that goes into the auction, right? And the banks grab it all, and essentially that money is coming out of the system because it's
not spent.
Yeah,
changes in TGA over the short run are the same as quantitative easing or tightening. So what happens is, and this literally happened, is that they went out and they did $1 trillion. I think it was $1 trillion in the COVID of TGA. They got the number way up there. And then they went and it took many, a year or so for them to spend it all. And so that money is going out, but it's already all being borrowed. So the change is what matters. And so what's happened with this TGA drawdown is that we've seen the government spend money that hasn't required any borrowing, because they'd already borrowed on. They'd already gone and borrowed, whenever they ran the TG up last time. And so that was like pushing liquidity into the system. And on the other hand, everyone's worried right now about the stock market because they're worried the governments go out. And I think that they're talking about raising it up, $500 billion over the next quarter of running the TGA back up. And when they run that back up, they're going to go and issue, $500 billion of T-bills and whatever, and they're not going to immediately spend it. So that is going to be a liquidity withdrawal from the system.
Yeah.
And that's kind of important to understand, is that one is an immediate, like the TGA is an immediate liquidity withdrawal or injection. And then the second thing, when they're talking about the Federal Reserve raising rates, that is a rate that is changing where they're trying to influence behavior in terms of private sector credit creation.
Right. So listen, the next question actually is still on this same topic. So why don't we quickly get that
Sure.
Into the mix here so that we cover it in the same in the same breath. Lena, go for it. Sorry.
Many are warning that a debt ceiling deal may actually be a sell the news event because it will trigger a barrage of new issuance, which will create significant new liquidity issues. This liquidity drain feels like the latest consensus crash catalyst among both bears and bulls. My question is whether such a well-telegraphed event may be priced into the market. In other words, can you actually price in the liquidity drain associated with over $500 billion of new debt issuance before it actually occurs?
So I think that they kind of depends on your beliefs about how efficient the market is, in terms of whether you think that the market can pre-position for that sort of liquidity. I would argue that you can't, and that there's no way that you could do that. But I will make a caveat here, and we've kind of, there's lots of moving parts here, but there's also something called the reverse repo program. And what the reverse repo program is in essence like the Federal Reserve taking extra liquidity from the kind of financial system and saying, I know that there's all this extra liquidity out there, and we're worried that if we don't sop up all the extra liquidity, then what's going to happen is rates are going to go below our policy rate. So therefore, what we're going to do is we're going to sop it up by offering a reverse repo, which is in essence like just them lending money over the short run to those people. That people give them a bond, the Federal Reserve says, okay, we'll or the other way around, the Federal Reserve sells them a bond and then says, we'll buy it back in a week's time or something. Okay.
Right.
So now the reason I mentioned this reverse repo program is because the reverse repo program is $2.16 trillion. And so, yes, there is a lot of concern about the $500 billion of TGA issuance that'll happen over the next 3 months. What people should be asking themselves is, how much of it is going to end up being sopped up by companies or market participants that are currently using the reverse repo program? Because if you think about it, if let's just say that everybody that was in the reverse repo program right now said, instead of doing that, I'm going to actually buy these $500 billion of new TGA issuance, then there would be no change in the liquidity of the financial system. On the other hand, if let's say nobody from the reverse repo program, did it, then you would have to find new buyers for $500 billion of securities. And in essence, that would be withdrawing liquidity and removing reserves from the system. So the real problem here is trying to decide how much of it is going to be kind of offset with the decline in the reverse repo program. The more that is offset, the less impactful the increase in the TGA will be on risk assets.
Right. Okay. I think that's enough.
Do we have any more? I can talk about it all
That's
day. I'm just trying to keep it a little tighter.
Oh, yeah. Yeah, that's tight. That was tight. That was definitely what I would define as tight. All right. Anyway, Lena, where can they submit their questions?
So if you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
And make sure you ask about the TGA if you wanted the questions to be tight. Or answers to be... All right. Anyway, so let's close this up.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Lena gets tired of talking to Patrick and myself. You know the deal. We're on all the podcasts. Patrick, where can they find you?
You can find me at bigpicturetrading.com or follow me on Twitter at Patrick Ceresna. Kev, how about you?
I'm on. I almost mentioned that the thing that starts with a T, but that's not where you can find me. Actually, go to the macrotourist.com, or if you want to check out our chat, you can go to the macrotourist.com/chat and come and join our group. There's always people there that are way smarter than Patrick or myself, and it's always a pleasure to have new people come. So the more the merrier. My only rule, someone asked me the other day what the rule is, and I said there's only one rule, and that's to be kind. All right, listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. Now stick around for the after show.
All right. That was nice and tight.
I know. I'm like, I listen.
That's your topic, buddy.
I know it's hard. It's hard to also explain it. Like if you make it too simple, like not simple, but if you make it too concise, people then will go be like, no, you don't understand, blah 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 blah, and like, I'm like, yeah, I know it. I'm trying to keep it tighter, but obviously I did not keep it as tight as I should have.
There you go. All right, let me rate this beer. Okay, so. I guess I think that the part that throws everyone off is when they say milkshake because it's but it just has a smoothness, like a silkiness almost to it. I think that's where that comes in. But it's just a fruity IPA in the end. It's got that passion fruit kind of a taste to the IPA. Not my favorite. I'm gonna give it a 6.9.
Did you finish it at least?
Yeah, actually, I finished it.
Of course, he finished it. It's Patrick.
You don't. No beer gets left behind.
No beer. That's a good line. The Market Huddle, where no beer gets left behind. Okay, I got a movie I went to. I don't actually know the name of it. It's the new BlackBerry movie.
Is it out?
It's about research in motion, and I'm just trying to get the name of it. What is? I guess it's called BlackBerry. Anyways,
and?
I must admit, I freaking loved it, and I get it. I talked to numerous people that were there in different forms, whether they were like. Listen, I didn't talk to anyone who's in the movie, but I talked to people that were like one row below people in the movie, and they're like, no, that guy's not like that, or no, this guy's not like that, or blah, blah. Kind of never let the truth get in the good way of a good story. It's actually great. It's entertaining as all heck, and I would highly recommend going to see it.
Well,
yeah.
Okay.
It was actually kind of amazing, Patrick, because I was listening to it, and I was doing it, and I had forgotten that, like, I remember putting it into the Toronto 35, and I specifically remember that because it was quite a wild ride in terms of my trading on that day. There were some big moves both ways, and but I also remember, like, I started work in the early 90s at RBC, and then I remember, like, them coming and it going into the TSC 300, and it's kind of amazing to see that. Kind of a couple years before they were in the TSC 300, they were just these dudes in like a strip mall, like putting shit together. And it was kind of amazing to see that transformation from really just like a shoestring kind of crappy company to this.
Did they do both the rise and the fall?
Yeah. Oh yeah. Yeah, no, it does not. It's not like they just rose it up and didn't tell the story on the way down.
Did they get into him trying to buy an NHL franchise?
Oh, 100%. Oh yeah.
Nice.
Oh no,
okay,
yeah.
Now I gotta
you gotta watch it. It's good. I really liked it. I thought it was really. I didn't expect much, and I was kind of surprised that we were even going. That my wife had chosen this, but it was like it was great. Anyways, it's not. There's not a lot of truth. Sorry. They've taken a lot of liberties, let's say that, but it's a great story. And do you know who's the main character? Is this guy, Jay Baruchel? I don't know how to say it. He's the guy in Knocked...
Baruchel?
Is that how you say it? So...
Yeah, the Canadian actor. There's a little Canadian,
so,
right?
You know, like in Knocked Up, when they're sitting around getting high and talking about like different stuff. Let me just see. Knocked Up. He's one of his friends, basically. Yeah.
Yeah. He's in a couple of other...
he's basically a Seth Rogen buddy, right?
Yeah.
Yeah. Anyways, he was pretty funny. He's pretty good. All right, Lee, how about you guys? You see anything good?
Nope.
Oh, no.
Patrick's like, what is this thing TV you talk of?
Yes, it's no good movies, but yeah, I don't know. Lena, have you watched anything?
No, I haven't watched anything. I've been just sightseeing.
Where were you sightseeing, Lena?
You know. Oh,
you're
in
still
Lisbon,
in Lisbon.
But I have Yeah, I'm gonna be somewhere else tomorrow.
That's great. And so, how have things been in Lisbon?
Oh, it's been great. What's not
it's
like?
awesome. Wonderful people, really kind. Did you go?
€3 wine. I can't say no.
Did you go anywhere new? Like, did you visit anything that you hadn't seen before?
I feel like I have, but all the days have been kind of a blur, to be honest.
This is what happens when you go and visit Patrick. The days blur into one.
Oh, it's no.
It's true.
What was cool was there was a boat ride where the dolphins were out, and they were swimming along along the boats. That was pretty cool,
cool.
in the harbor area. But
did not expect to see dolphins in Portugal.
It is an ocean.
Well, they were surprised. They were surprised to see you, Lena, as well.
Anyway.
Okay, well, we'll let you guys go. Have a great night, everyone. We'll see you in a couple of weeks.
Have a great night, everyone.